Welcome to Trader Talk, where we dish out the latest Wall Street buzz to keep your portfolio sizzling. I'm Kenny Polcari, coming to you live from the Yahoo Finance headquarters here in the heart of New York City, a global hub where deals are made, fortunes are built, and the next market move is always around the corner. Today I'm going to chat with my good friend, Carson Group Chief Market Strategist Ryan Detrick, and then you can stick around for the pasta fagioli recipe. Before joining Carson, Ryan spent over 6 years as Chief Market Strategist at LPL Financial, and earlier in his career, he honed his analytical skills at Schaefer's Investment Management. He holds a bachelor's in finance from Xavier University and an MBA from Miami University, as well as the Chartered Market Technician designation. Ryan is regularly featured on Yahoo Finance, CNBC, Fox Business, and Bloomberg. Well, Ryan, welcome to the show, and thank you for joining us.
Kenny, thank you for having me. I appreciate it. I just hope we have something to talk about. I don't know, it's kind of boring out there, but I think we'll be okay. Yeah.
For some reason, I think you and I are going to have plenty to talk about. I saw you this morning on CNBC with Morgan Brennan. I thought that was a great, it was great for her. It was her first show. It was great for you. Mm-hmm. Once again, I always enjoy your level of excitement and your outlook, your positive outlook, very much like me. So I'm excited to have this. So why don't we jump right in and just talk about this 2026 outlook? Because I know you have a fairly aggressive, you or Carson Group has a fairly aggressive view of where we're going to be.
You're right there, and a lot there. I like to look. I keep it simple. I'm a simple fella at the end of the day. I look at credit spreads and I look at advanced decline lines, Kenny. Credit spreads are still telling us there's no stress in the system. If there was this monster under the bed that they kept telling us is there, we would see it, right? High yield relative to treasuries is like breaking out to multi-year highs. The way I learned it, that's a good sign that credit's not worried. Then advanced decline lines, I think the big story so far this year has been participation. Now, tech peaked in late October, right? And it's kind of gone sideways, struggled a little bit, but other areas, industrials have done great. I mean, energy and materials, obviously, clearly small caps. We just had 14 days in a row of the Russell 2 small caps outperforming the S&P 500, like one of the longest streaks we've ever seen. But the lifeblood to a bull market is rotation. And when we see new highs in advanced decline lines, that's market breadth, which is what we've just been seeing like literally this week and last week, that normally means there's at least another 9 to 12 months before the market historically has peaked. So long story short, we're stretched. Maybe we're due for some volatility, right? It is a midterm year, 17.5% peak to trough correction on average in a midterm year. And everybody remembers the last two, 2018 and 2022, not good years for investors. But we can use the F word on this, right? The F word, the Fed, that's my F word joke, Kenny. Figure you'd like that, freeze you for a little bit. Anyway, but the Fed was hawkish in 18 and 22. They're not, we can talk more about the Fed if you want. The Fed is not hawkish now. That's a big difference between those last couple of midterm years that weren't great for investors.
Well, I want you to do two things. First of all, yes, I agree with you. If you've noticed in the first 3 weeks of this year alone, the SMIDs, the small and mid caps, are up 9.2%, way ahead of the S&P. I think it was up 0.5% year to date. Now, the industrials, I think, were up a couple of percent. Transports are up 4%. The equal weight S&P was up 4%. So, yes, SMIDs, to your point, are really breaking out and setting themselves up for what I think is also going to be a very good year for them. But I want you to explain one thing, because I think this is interesting, and I think some of the listeners may not be clear. So can you define or explain to the listener when you say credit spreads? Explain to them what that means and why they should think about that.
Yeah, there's a lot of ways to do this. I look at things like triple B spreads, right? Like companies that are kind of, I don't know, they call it junk bonds. I mean, technically, they always call them junk bonds. Now we call them high yield. If you're worried about getting paid back and you're investing in those, you need to get a little bit higher premium, right? The market sets this, right?
Right.
So when there's not a big high premium from the market for investing in more of the riskier, quote unquote, companies to get paid back if you're going to loan them money, that's kind of what we're talking about when we talk about credit spreads.
Right.
Now, again, I like relative things like, the S&P 500 relative to small caps and this and that. I mentioned it earlier, but if you look at like high yield relative to treasuries, think about when what hits the fan. Treasuries usually do better. Well, high yield's usually not going to do very well. We're not seeing that at all right now. We're seeing that continued kind of appetite for risk, I guess is what I would call it. And I think that's a real important factor. One more comment on this, last August of 2024, when we had the yen carry trade unwind, April of last year, when we had the big near bear market, obviously around Liberation Day. we looked at these things, and honestly, Kenny, back then, the credit spreads were not saying it's a monster in the bed. Even last April, in the middle of a virtual bear market, we weren't seeing credit blowing out, credit freaking out. It was stressed, yes, but it was saying this is more of a, kind of not, this isn't the first domino to fall to take the whole system down. And that's why I've done this for a while, and I've always said, you probably, they say the bond market's the smartest people in the room. I'm not 100% sure on that. I think the credit markets, that part of the bond market, are the smartest, is what I would say.
Right. All right, so let's talk about your triple tailwinds, which are a dovish Fed, supportive fiscal policy, and ongoing AI CapEx growth. But let's start with this dovish Fed, because I don't know if I'm in the same camp with you. And so I want to hear your position, and then I'll tell you what I think about the Fed.
Absolutely. So to get to that, we probably need to talk about inflation for a second. Inflation is stickier. I mean, inflation is closer to 3% than 2%.
We agree.
Like, we've modeled our portfolios that we run for our advisors to be in a 3% inflation world, having some, metals and mining, having less bond exposure, having some gold in there. So that's where we are. But the truth, again, the Fed's probably not going to do anything here until after May, when we have a new Fed chairperson. Who knows? Maybe it'll be Rick Rieder. We don't know. We'll see. But the reality is we probably still see a cut or two the second half of this year. They're not hiking. I don't think there's any real reason to think they should be hiking yet, because inflation is such a confusing situation, because you have commodities clearly that are going higher, but then shelter, which makes up 42% of core CPI, that is starting to finally come down as rent prices and things come down. So there's some yin and some yang when you look at inflation. But again, big picture, we think the economy's strong. Inflation running at 3%, it's not spectacular, but you know what? It's not the end of the world either. And go back and look at history, everyone. Inflation is usually like 3.5% a year on average. Usually it's which way it's trending that matters a lot more. So we'd still say the Fed is a little more dovish here than hawkish. As we go forward. One more, I can go all day on this stuff. One more. When the Fed cuts near an all-time high, like they did, Kenny, just last quarter in December, November, and October, a year later, the S&P 500 is higher 22 out of 22 times. I mean, that's the old saying, don't fight the Fed. I mean, that right there tells you they can cut near all-time highs, and they just did it, and usually it means you're probably going to be higher a year later. So that's just one little data point to have in the back of your mind.
Okay, so I will tell you, I'm glad to hear you say that, because you and I agree on 90% of what you said, because I agree the Fed's not cutting. They're not cutting. They're not cutting in January. They're not going to cut at the next meeting. And in my mind, in my head, the next cut is going to come after we get the new Fed chair. I don't think it's going to happen before then. I don't think Powell's going to cave. Nor do I think he's going to change his message. I think his message is going to remain the same. We remain data dependent, and right now the data says that we hold. I think that's what he's going to say, right? Now, that being said, I don't personally see a rate cut coming. Now, I don't see it coming because I'm not sure we need it. I think if we get one, it's going to be because they're going to force it on the Fed. That the new Fed chairman, whoever it is going to force it. Now, we can talk about that too, because I am thrilled that you said Rick Rieder, because I've had my money on Rick Rieder since his name first came up as the dark horse in the race. And if you notice what happened over the weekend when Kalshi, the predictive markets, Rick Rieder went from a 20% shot to a 50% shot, and Kevin Warsh went from 65 down to 30. So I'm curious what's going on there, because I love the idea of Rick Rieder being the next Fed chair. So I think the market is kind of suggesting it should look away from the typical or usual. Rick Rieder would be an outsider, but I think Rick Rieder, I think he's fantastic. I think he would be a tremendous Fed chair. And so I'm curious if you have a thought. Are you in the Rick Rieder camp?
I think I am. I think a lot of us, market geeks are, because he is an outsider. He 100%. Didn't he's not maybe he has a doctorate. If he is, I'm sorry, but he's not versed in this stuff. He's real world. He's been doing this. Listen, when you manage real money and you work with people and you work with emotions, it's a lot different than just writing a newsletter. I mean, all of us that have done that, we know that. And he's done that. And he's a great communicator. Obviously, he's been in front of a camera most of his career. I'm not saying the Fed has to be in front of a camera, but most of the Fed chair people are pretty darn boring. I mean, Janet Yellen has a really good personality, but she had to act a certain way in front of the camera. And then you get her a beer. She's hilarious, by the way. But for the most part, I think Rieder will be an excellent communicator, which the Fed needs to do that anymore. But also, he'll be more real world. I don't think he's going to be set in his ways. I'm hawkish, I'm dovish, I'm this or that. But let's be clear with something you just said. I'll wrap it up with this. The truth is, who gets picked the next Fed chairperson? The president. There's probably like a little bit of a pressure that, yeah, you better cut a couple times this year just to keep your boss happy. And then once you get through that first year, then you know what? Then you can go from there. I'm not saying it's right. I'm not saying it's wrong. I'm just saying it's kind of where we are.
Okay, keep that thought for 1 minute. We're going to take a break and come right back. Okay, I want to pick up on that thought because you're right. Whoever it is, Rick Reeder or Kevin Warsh or someone else, they are going to get pressure, I think, coming from the administration to do something. Now, I'm in the camp that I think we're good. Unless the data starts to fall off the edge of fall off the edge, I don't see why we have to go any further from where we are. We're at 3.25, 3.5 right now.
Right.
We are well within what's considered a normal range. We're not at the high end. We're not at the low end. But I don't think the economic data suggests or demands that we be much lower. I mean, look at this. You just said it. We're going to see great earnings. We're going to see great forward guidance. We're going to see stronger economic data. PMIs remain in the expansion zone. Right. The jobless claims numbers and all that. That's not falling off the edge at all. Right. We're not seeing jobless claims and continuous claims suddenly spike up. We're not seeing unemployment spike up. It actually ticked down in the last NFP report at 4.4%, which is considered full employment. So we're not in an area where, where unemployment is 6% or 6.5%, where you start to say, okay, there's something wrong here. At 4.4%, that doesn't scream to me the place is on fire.
No, I don't disagree with what you're saying. I mean, it's clearly not on fire, I think. We did just have 7 months in a row of alternating up, down on jobs data. So there, that's the first time since late 60s, early 70s. So we get it since Liberation Day and the different things happening with immigration policy and all that stuff. The truth is the labor market is weak-ish. Is it cracking? I don't think it's cracking. We're in a low hire, low fire environment right now.
Right.
And again, I think the time we're doing this, Fed fund futures are looking for like a 0.42 or 0.43 of cuts. So that's less than 2 cuts. It's less than 2 cuts. Again, at the start of the year, people were saying 3 or 4 cuts. We always said it'd probably be more like 2 or 3. So we may be a little bit on the under. And even with our models that we run on bonds and things like that, we're kind of even weight bonds at most in terms of duration, I should say, even rate duration. So we're not at the long end. We don't think they're going to cut massively. We think the economy is on pretty good footing. We just still think, to get the job, maybe there's a handshake you need to cut a couple times, and that's where we are.
All right, so let's finish that first conversation about the triple tailwinds, because then you are assuming that we're going to have accommodative fiscal policy.
Yeah.
Right, and that ongoing continued AI capex spend, which I agree with you. I think all those things are true, which suggests again to me that the economy is going to be fine, and the markets are going to do well.
Yes, AI, I mean, it is what it is. It's not slowing down. Our friend Dan Ives keeps talking about this. It's not slowing down. The 5 largest companies in the U.S. are looking to spend like $520 to $550 billion in CapEx. That number keeps increasing. We'll see this earnings season how it shakes out, but Taiwan Semi recently said AI spending is not slowing down. Then the fiscal side of things, the tax cuts that went in play last year, with a lot of people getting retroactive in their paychecks just right now. Some of those tax withholding schedules are changing. There's the deductions on tips. There's deductions on elderly incomes. There's different things that people. Oh, by the way, Wells Fargo came out and said the average. Again, no such thing as average. I get it, but the average tax return is going to be up 18% this year from last year. I don't think most people realize that, Kenny. They're going to go get their taxes, have an extra, $500, $600, $700, $800 in there. Which, hey, that. What have we seen before with consumers when we gave them money back in 2020 and 21 and 22? Well, they're going to go spend it or pay some debt. So that's kind of where we are. So I think the fiscal policy is a positive. AI spending also. Last comment on AI. The first half of I love stats. I know you do too. This is one of my favorite ones from last year. The first half of last year, our economy, U.S., grew 2.2%. Now, it really picked up the second half of the year. But anyway, first half of the year, 2.2%. 1.1% of that, so if my math is right, half of that was AI and CapEx. Now, listen, that kind of, went down overall as the rest of the economy improved second half of last year. But that tells you right there that AI CapEx spending is a real part of this economy that can keep it going. And one more thing I want to point out. We talk about GDP and earnings, all stuff. Productivity in our country, the third quarter is up 4.9%. It was close to 4% the quarter before that. Go back and look at history. When you have strong productivity, you know what you also have those years? Better economy, better
Right.
earnings and better stock market returns. We saw that in 23 and 24 big time. And then last year sort of pick up again. So I think in this low hire, low fire world that we're in, you tend to have better productivity. And that tends to be the magic elixir to pay a little bit higher wages, puts a little bit of a cap on inflation. We talked about inflation a lot earlier. I think a cap around 3% makes sense, especially if productivity continues to improve here, which we think it can.
Listen, I think the Fed has now accepted 3% as the rate.
Yeah.
The whole talk about getting
Agreed.
to 2%, I don't think we're getting to 2%. And I think the Fed has already in their minds, they haven't said it, I think in their minds they're accepting 3% inflation rate. Right? And so as long as wages continue to grow and they're growing faster than the rate of inflation and people can start to feel like they're not only keeping up but improving, then I think things are okay. But if people are looking for prices, physical prices of things to come down, they're not going to come down unless we have a full-blown recession in this country, which nobody really wants. But if you want to see the price of chicken and meat come down, okay, you're going to have a full-blown recession in this country. Right?
Yeah,
You agree?
That's a great point. Yeah, I've used that for a couple of years now. When you talk to clients and say,
Right.
hey, maybe the toilet paper you bought used to cost $15, now it's $22. When's it going to go to 15? And everyone kind of gets it. Never, because if it does, we've got a really big problem on our hands. And look at utility bills. And my goodness, as cold as everybody heating up their house, all over the country right now, utility bills have really soared. Natural gas obviously soared. I mean, crude oil's down here, but most other commodities are up there. So there is that upward bias that's out there. And you mentioned wages. Wages are still solid, but wages have been coming down year over year. Again, maybe potentially putting a little bit of a lid, if you will, on inflation. At the end of the day, wages are a big part of inflation. So it's a messy crystal ball for sure. But the reality again is, I just think this 3% inflation makes a lot of sense. Not 2%. I love what you said there about the Fed. They're not going to come out and say it, but I think they understand. Right. And again, look back at history, everybody. What we just went through for 15 years during the ZERP period. 2% inflation really isn't that normal. What happens with that? Well, you have low yields. You don't get anything for cash. There's some negatives to that. So 3%, we're good with it. We're good with 3% inflation.
I agree with you. I think 3%. I think people just they're going to have to just get used to that. Because they were conditioned to think it's 2. The Fed's going to go to 2. We're not going to do anything to get to 2. We're not getting to 2. We're just not getting it. We'll get close, but we're not getting to 2. And so that's why I think right where we are, 2.83% is actually okay. Okay, so let's talk about concentration myth. There are 500 names in the S&P 500. There are 7 of them are MAG, right? The MAG 7 names. But there are 493 other names that are in the S&P 500. So I think you and I are very much on the same page about this. But go ahead, talk about the myth.
Yeah, so great question. So we've heard for years there's only 7 stocks going up. Now I think that's kind of gone out a little bit. I think because people are realizing literally like last week the S&P 500 equal weight hit an all-time high. So again, yes, on market cap weight in 23 and 24, if you didn't have a big allocation to large cap tech, we underperformed your benchmark, you underperformed your peers, you underperformed everybody. But what we're seeing now clearly is more of a broadening out theme. And we look at like the S&P 500 last year gained right about 19% on a total return basis. Last year was the first year in 4 years where the 493 actually contributed more to that gain than the MAG 7. Yeah, the MAG 7 a couple years before obviously contributed more. And I think these are some important things. The other thing that I think is neat, we looked at 25 of the largest developed countries and looked at their ETFs, right? And we looked at the 10 components. How much of the 10 components of their overall stock market? Well, U.S. is 39%. We've heard this for a while. The top 10 are 40%. The media tell you that like it's bad. I'm not saying it's bad or good. I'm just saying then you look at the data, Kenny. That is actually one of the lowest top 10 concentrations out of all of them. I think it's India and Japan are lower than us. So obviously it's less than 39%, wherever that is. But most developed countries around the globe, their 10 largest companies attribute more. And I get it. It's because they're small-ish countries in Europe. They've got a couple big companies. That's why. But listen, if we're saying the U.S. is so top heavy, I'm looking around the globe. We're not as top heavy as other places. That's busting some myths that are out there from that only 7 stocks, and we're top heavy, in my opinion.
Yeah, no, and I agree with you. And I think we are, and we made this point at the very beginning. If you look at what's happening, there are certainly other areas of the market that are excelling. SMIDs for sure, and SMIDs are typically not part of the MAG 7. So you got to look beyond just the 7 names. I'm not saying get rid of the 7 names, not at all. I'm just saying there are, like you, that there are other opportunities.
Right.
Okay, so
Agreed.
talk to us about your bull market cycle theory about that in your opinion we're still in kind of the younger stages of this bull market and that there's a longer runway ahead of us.
Yeah, when I say this, it sometimes surprises people, but this bull market turned 3 last October. Remember October, I forget when it was, October 12th or 13th of 2022, vicious bear market, and market's been rallying ever since. So we're in the 4th year of this bull market. Kenny, we went back 50 years. We found 5 other bull markets that made it into their 4th year. There were some that were shorter, but they kind of, flamed out fast. But once you get extended like this, get moving, I say bull markets are like a cruise ship. Once they get moving, they're hard to slow down, they're hard to stop, they're really hard to turn around. Well, looking at those other 5 bull markets that made it to this point, the last 50 years, the average length was 8 years before they actually peaked. The shortest was 5, and then we had 2 that went double digits. I have no idea how long this was going to go, but I guess what we're really trying to stress is this bull market is likely much younger than most people think. And then you want to get real wild with it. I mean, small caps just now are breaking out to levels they were trading at 4 years ago, right? Energy stocks were literally at the level they were trading at 17 or 18 years ago. How about Germany? Germany just last year, and Europe for this matter, the German DAX just broke out above levels early last year. It was trading at in 2007, 2008. So I'm talking about the U.S., yes, but we can look at other parts of the globe, and you could argue, and I am, that some of these bull markets are really, really young, and those are some areas you want to have. Last comment on this, we manage real money. We've been overweight equities a while. Yes, we have a globally diversified portfolio. We like the U.S., we like developed international, don't like EM quite as much. We don't really trust China. But again, for a portfolio point of view, you want to own a lot of these other areas. We don't think last year was a one-off. We think this outperformance from the rest of the globe, or at least keeping up with the U.S. from the rest of the globe point of view, is probably here to stay for several years.
Yeah. Listen, Ryan, I could talk to you about this all day. Today, I'm going to give you pasta fagioli. Now, pasta fagioli dates back to ancient Italy, when beans were the primary source of protein long before meat was even affordable. Early versions were essentially bean stews sticking with whatever grain or pasta was on hand. As dried pasta became more common in the Middle Ages, the dish evolved into this comforting marriage that we now know as pasta and beans, olive oil, aromatics, and a tomato sauce, right? Now, there was never one recipe. In northern Italy, it might be lighter. Sometimes it's going to be a different bean. Sometimes it's with a touch of pancetta. In the south, it's heartier. Garlic, tomatoes, rosemary, maybe even the rind of the Parmigiano or the Pecorino Romano that simmers slow in the sauce. Listen, I made this yesterday in the middle of this snowstorm, and I made it the southern Italian way, but I put the pancetta in there. Oh, my God, it's so good. But when the Italian immigrants came to America in the late 19th and early 20th centuries, pasta fagioli came with them. Why? Because it was cheap, it was filling, and it was endlessly adaptable, earning its place as a staple in the Italian-American comfort food. At its core, it's not fancy, and that's the point. Proof that simple ingredients treated with respect, just like your portfolio, can be unforgettable. Now, you can scan the QR code on the screen for the full recipe, and trust me, you will thank me later. That's a wrap for today's Trader Talk, but the conversation continues. Subscribe on Apple Podcasts, Spotify, Amazon Music, or wherever you get your podcasts. If you got questions or topics you want covered, email me at tradertalk@yahooinc.com because we're always listening. Until the next time, stay sharp, stay disciplined, and stay in touch. Take good care.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.